What's up, everybody? Good morning. Welcome to the stream. What's up, everybody? Good morning. We are live. We are back. What's up, friends? Ooh, we are back in the saddle. Nice brand new live stream right in the middle of the market crashing. How about that? Stock market's crashing today. What are we gonna do about it? I say crashing. Well, I could define a crash as a 3-day move where the market is a red candle on the daily chart, where the end of the day closes lower than the previous day's close. Red, red, red. By day 3, I start calling it a crash. What's causing it? Is this permanent? Is this temporary? Will we recover? We'll have all the information on that. So welcome, guys. Welcome to the stream. Everyone hit that like button this morning. Thoughts on why the market's crashing? We're going to talk about that all day today. Liquid markets don't crash. They don't crash in the long haul. Markets can have periods of illiquidity. Things can trigger the market to sell off, which is what we're seeing right now. But is this a permanent thing? We'll talk about all the factors that are leading into what's going on today. Of course, the market is liquid enough to find itself a bottom at some point. Is it here? We don't know, but we'll talk about that in a little bit. I don't know, guys. Like someone said in chat, it feels like it might be a red day today, so I don't really know. But we'll check it out. We'll take a look at it. If you are here for the first time, hit that sub button, because we are giving the best market coverage there is. Stop watching people gambling and paper trading accounts on the internet. So here with the pros. All right, we got this. You guys ready? You ready for this? All right, let's start talking. I got Thinkorswim up front and center. First and foremost, we got to analyze the VIX. How much the VIX has moved today? 10.25. All right, this is rule number 1 when it comes to day trading. Okay. VIX has a risk interval. Everyone in chat, type that number if you know what it is. Do you know what that number is? 2.8. If the VIX is traded more than 2.8, VIX futures 2.8, you do not trade on a day like this. I will warn you that this is going to be the worst trading day of your life. I don't care if you're longing. I don't care if you're shorting. I don't care if you're doing anything. If you touch the market while the VIX has moved 10 points, VIX futures 45% overnight, you are a fucking moron. Don't touch the market today, and I'm warning you right now. Don't touch the market. It will not be your friend today. This is not the time to think about what you're going to do when the markets are this chaotic. Let Wall Street play the game. Let the big boys play the game. This is billions and billions and billions of dollars of leverage just unwinding. Let it unwind. Let it do its thing. Trust me when I tell you I've been trading for, God, what is 14, almost 15 years. It will find a bottom at some point. It doesn't technically find bottoms usually on the day that it is devastatingly selling off. The morning you wake up. I never wake up on days like this and say, oh, I can't wait to buy the dip. I wake up on days like this and say, thank God I wasn't in this shit when it fell. I don't think I want to get in it either. So what we're going to do is we're going to map out some of our levels here that are very key and very important. Let me delete this. We need to monitor and get some... We need to find some downside targets here. And we'll talk about this a little bit. How much time we have to market open? 10 minutes till market opens. All right. Okay, we need to come in here and mark up some LAs. We'll do this in a little bit, but downside targets, we're clearing out red lines left and right. Looks like our 5139 pivot's what we're going to be fighting at today. So keep an eye out of what's going on today. It can bounce and pivot, but like I said, let the market do its thing before you try to be a hero. Okay, key pivots today, 5139 on the S&P. Key pivot below that, the 86. Okay, write these things down. Key pivots on NASDAQ. Seriously, everyone hit that like button. I'm going to tell you, rule number one, smash it. 17,500 was our key level on the NASDAQ. I need to start cleaning up some of this. Dead, 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 and there's that, and let's move that there. Get that out of the way. All right, so NASDAQ key pivots today, 17,906. And 16,530. Okay. Yeah, that's it. Take a look at that. All right. Let's go to the big screen here and let everybody know. Okay, so our rules are in effect. Look in your, everybody go right here. Go to your DD table right here. Scroll all the way down to the bottom. Find the VIX. VIX will tell you your risk interval. This is $2.80. VIX futures move that far. You don't touch the market. Don't touch the market. And I promise you, promise you, let the market do its thing. There will be a chance where you'll find places. And never, and I'll tell you, I will tell you, never wake up and say, oh, well, maybe I can short this. So markets crash and great time to get on the short. If you didn't see the crash where it happened, you're in late. So this is not a time for you to come in there and say, this is where I'm going to find my financial freedom. This is where I'm going to quit my job. This is where you walk up here and you say, you know what? Let's let the big boys play today and let's just watch. I'll talk about the mechanics going into the crash, what's causing this to happen, and how I think we're going to recover at some point. We'll look at the monthly maps and have that detail that for us. Today's way out the charts, but we're going to do it anyways. 53.79. We're going to mark this with our overnight dynamics. This comes from the Discord. A bot produces this. These are hedge pressure levels for institutions. 54.20. Way up here, right? Okay, let's look at the monthly. 53.69. Yeah, this market's fucked today. Okay. S&P trading way below key levels. Just let it do its thing. NASDAQ, same thing. Fed emergency meeting today. I think time for liquidity injection plunge. There may be an emergency rate cut. Just, you know, we had the Bank of Japan raising rates. You know, these are things that are triggering the market. There's global instability. You've got things going on in the Middle East, triggering a little bit of panic as well. The whole war is imminent rhetoric, which you hear a lot of the time. Market's sensitive on top of sensitive, and you're going to see those things happen. Not too bad. All right, 678. Monthly is here. 616. All right, your first time here, don't forget to sub to the channel. We're live every single morning and every single afternoon. We'll be doing Twitter Spaces later with Wolf Financial and stock market news, a bunch of your big favorites. Talking about this market crash. It's going to be a huge deal today. And what happens, you know, my general saying is that liquid markets don't crash. We're going to examine the liquidity today and see if the market is actually liquid. 78, 823. Wow, way out of balance here. Okay. So another thing to take note of, right? The market is closing outside of DD bands, or opening outside of DD bands. This automatically sit out number 2. All 3 of the lights on our warning signs are red over here. Okay. We've got about 5 minutes till the market opens. Let's say we'll detail some cool historic crash stuff. What's up, Beavis? What up? What up? Yeah, Jim was like, I don't know, but I think this is gonna be a red day. You want to see November 1? Yeah, like yeah. Now this is probably the worst, I think the worst pre-market day we've seen in the S&P since March 12th of 2020, which should be COVID crash number 2 of 3. We'll talk about those today as well. Rational market attorney. Can you talk about the risk interval rule? Yeah. So what typically happens when the VIX has moved, and I'll just show you a quickie. Wait till the market opens to talk about that. Actually, let me just bring it on the screen. All right. Well, if my mouse wants to play ball, there we go. All right. Okay, ignore all the lines on here. This is my, let me go ahead and just make a default chart, a blank one. Yeah. Okay, let me show you guys what happens when the VIX goes that distance, okay? $2.80, you go to this table, you go to VIX, you go to risk interval. This is $2.80, okay? And then you go, and I'll show you what happens. And again, that number changes when the margin requirements change. But anytime the market moves this much, let's just make a box of that distance. Let's make it $2.80. VIX futures trading upwards of what, 36, 38. VIX itself is like what, 70 or 80 today, something like that. I can only assume. I don't know the conversion top of my head. Yep, closer to 70. So that was pretty close. Yeah, that's pretty heavy. All right, so normally the VIX, even on the worst days, like we had some selling days previously, the VIX tends to stay inside of this range. Everybody see this? Even big sell-off days tend to go exactly that distance pretty much on the big move before they pivot. Look how lovely and accurate that is. The market hates to go unstable. And when the volatility itself becomes unstable, the volatility of the VIX, which is something known as the VVIX, that is not VIX, but VVIX. The volatility of the VIX not only showcases that when there's high volatility, the floor of the S&P is thinner and the bid and ask is wider and there's less buyers to catch the fall. But when the volatility of the VIX is bigger, it means the VIX itself can become volatile, which means the floor become exponentially thinner and the bid and ask exponentially wider. The exponential scattering of buyers and sellers that can cause the market to parabolically sell off, which is pretty problematic. So whenever the VIX is trading beyond this range, there's an entire month of futures, doesn't break it in a single day, and a single day moves that distance, you look out of the way of the market or you're an idiot. I'm just saying it. Look like this. Here's a big runaway reaction as well. You can't unsee it. Look how exact our calculation is. This risk interval is an exploit the margin requirements in futures. If you do this right, it is on exactly the nose. Once it runs away, it hits exactly that pivot and turns around. Our calculations are that razor sharp, rockets here. We're the people that hack the market. You guys know that. Look at this. Do you guys see that? It is pivoting exactly on the nose from the move. From the move, on the nose, and usually it takes an insurmountable amount of volume to break through that on the VIX. The VIX is so heavily hedged at those boundaries. When you break it, the building will collapse. That's all you have to think about. And then normal days, it doesn't break that almost ever unless the market's crashing. So normal days, even big selling days, usually will run away and return to that level. Even the big runaway here, we see how it pushed right to there, came up and came back down. It usually will snap back into place very quickly if it can, but once you break through it, this is the no trading range at all. Do we all got it? Check, check. Get some yeses in chat. I want everyone to understand today is not the day for you to go out there and fuck around in your trading account. We got it? Do we got it? I made 2 videos and published them about how your trading account can go negative near circuit breakers as well as something to take note of. So we're not close to it yet. We need 7% to hit it. And I don't think we're going to hit it today. This is pretty bad selling. I don't think we're going to hit that circuit breaker today. But just so you know, whenever you get that close on VIX, don't even touch it. Don't even touch it. I will show you that parabolic selling. Okay. So let's look at something really quick. This is a neat little trick. Let's go ahead and put like a well, let's see. Hourly chart, let's put them side by side. So let me show you what happens the moment the VIX does this, okay? If you guys take note of this, this is gonna teach you something you didn't know. I have traded since 2010. I have seen the 2008 market crash. I've seen the trade wars of the Trump era market crash. I've seen the COVID market crash. I've seen it all. I'm gonna tell you how this works. I've been here long enough to know all the ropes. I'm gonna show you. So you guys hit that like button here. Let's go. I'm going to show you guys. Thumbs up at the bottom. Clock into your daily trading shift. And I'm going to teach you how to save your ass today, okay? Let's make this box $2.80. And let me show you how parabolic moves happen when the VVIX is moving that much. This is something, once I show you, notice I'm not even care about the stock market right now. Neither should you. This is not investment advice. Okay, this is skincare advice. You know, I hear that at this point in time, your hands get a little clammy, right? You get a little nervous. So what you do to fix that, is take your hands, you plant them underneath your ass, and you fucking sit on them all day. You sit there and you sit on your hands. It's great exfoliation of the dry skin of your hands. And at the same time, you won't touch your mouse either. Literally gonna help you out. I'm not a dermatologist, but I promise it's the best thing you can do for your hands right now. Just sit on them. Okay. This is what happens when you go more than a single risk interval, which is part of the margin requirements performance bond minimum calculation the CME group puts together. All right. Let me show you something. The moment you trade beyond that distance, just that distance alone, watch what happens. Okay. You notice how volume starts to exponentially pick up in the VIX. This is number 1. So far, so good. Let me put this exactly where their move takes off. So at exactly 22:45 overnight, you know, say, hey, what's up, Luigi? We all see this, right? Everyone see this? Okay. Now, what's neat is that, let's look at liquidity maps really quick. We'll circle right back. Let's do the opening. Even though market selling, we have stability, strangely enough. Now, like I said, overshoots are big and this is problematic, but there are some pivots showing up. Let me show you today's range we're trading on really quickly before I go back to the lesson. So don't leave yet. This lesson is going to be, you're going to love this lesson, okay? Here we go. Resilience is negative. This is resistance to here. That's likely to break. If we do break, there's your trade today at the bottom. Again, I'm not trading here. This is here. This is a range. Again, res is negative. Okay. This is worse. This is the worst case. This is the bad case. There is no good case today. If there is any kind of shoot from the hip maverick playing the game today, you got a hedge pressure really close to S&P. The problem is you've got a bullish liquidity map on VIX. VIX is going to have pressure from there and pressure from there, which means whatever upside we have will immediately be slammed when VIX turns around and pivots. Do we understand? So whatever, even if the market trickles and trickles and trickles and trickles, and this goes la da 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 da, the minute that hits, violence resumes. Okay, so this is like my buddy Keith, who was a annuities trader, dealt in fixed income. He said in market crashes, that's when people dive into fixed income, and he loves it because activity picks up. And he tells people that buying a dip and catching a falling knife called it picking up pennies in front of a steamroller. He's like, don't go in there and try to scalp little bits here and there, because once that volatility kicks back in, the steamroller turns on and you're toast. All right, so you got a bounce plate at bull zone bottom over here on Russell as well. So everything is pointing down. You have here, so it's probably going to be like a trickle up and maybe back down. So right now, no shorting to go lower. If I were to short, I always short from here. So Matt's will always short against MHP on the bottom. So I'm gonna wait for that to happen. I never jump in, dive in. Do we all understand that? So far so good? All right. Okay, back to the lesson. I'll catch that. All right. So what happens when the VIX moves exactly one risk interval? And the risk interval is it's a technique that we've created that's just exploiting margin requirements. Let me show you what happens at exactly that moment. Rule number one, the volume starts to rapidly pick up in the VIX. Do we all see that? So far, so good. The VIX becomes uncontrollable. The candles of the VIX themselves become crazy within what? 1, 2, 3, 4, 5 times 6 is 30 minutes of this happening. In a 5-minute candle, the VIX goes 1.5 points within 1, 2, 3, 15 minutes of that happening. And then it subsequently has a candle 10 minutes, 15 minutes later. The VIX goes up another 2 points, then another 2 points, and then retraces 2. Do you see how the volatility, which itself is rather stable, the candles themselves are okay, but the candles of the volatility get wild? Look at the VIX swinging 2 points and then down 1 point and then up 2 points and then down 2 points. That's the entire risk interval all by itself. Do we see how when you move that far, the VIX just spirals out of control? Everyone type yes in chat if you see it. This is a lesson that will save your ass when you're trading. Y'all see it? You guys got it? So far, so good? Okay. So the reason we have a rule that states don't trade when that happens, because when the VIX itself is going up and down 2 and 3 points in a single couple of minute period, the S&P will exponentially move. Now, again, this is not something, heroes aren't born on days like this, but let me show you exactly what happens at 22:45. And I haven't even prepared for this. I'm just so rehearsed in this exact speech because I've been trading for a long enough time. I'm going to show you exactly at that candle what's going to happen. Let's find exactly that moment. 22:35 to 45. That's when we broke. Let's zoom in on it. Just so we don't lose sight of it, let's go ahead and draw a circle around it. So what happens, again, it's such a predictable thing that I'm showing you, is that I don't even have to check before the stream. Happens all the time. So what typically happens is that you can actually map this out. When I say parabolic selling, it's very simple. Is everybody, one can argue that that's relatively linear, right? It's kind of a channel, right? We all see that? So far, so good. The lows are hitting here and here and here, and then, you know, breaking and coming up here, but basically channel-ish. So far, so good. And that's when the VIX is in that stable zone. A 1 RI break, and again, this number, you have to subscribe to our platform to get this number. This number updates in real time. When the margin requirements will change, we will give you the new value, 2.8. The minute you break through 2.8, which is right here, what happens is the lows get exponentially lower. You're no longer trading lower lows like this. You are trading lower lows like this, where it speeds up. You can connect the bottoms with a curve. So when the VVIX is going out of control, the stock market curves lower instead of goes lower. And the volatility is so wild that you'll get caught off guard so quickly in your swings that you will blow up your account before you even know that it's happening. So we teach you the moment this happens right here, stay away from the market, because it's no longer the V's get exponentially bigger. When you're trading channels like this, okay, VIX might be getting linearly bigger. Okay, you can draw a straight line of the S&P. VIX, S&P is linear here. S&P is parabolic or exponential, actually more like exponential. So it's no longer measurable on how far it falls. And one can see that the moment that that breaks, it starts to curve and then snaps back up and then sells again. It's so wildly uncontrollable. And this is just the NASDAQ, but let me look at the S&P. Same thing. Thought I was on the S&P, but it's the same shit. The reason this happens is the way the VIX equation is structured, and it's just looking at prices of options and supply and demand of options. When the market starts to spiral out of control, people are going to rush into options pretty crazily. Now, let me tell you how bad things are when you're trading in this regime. In the last, I don't know, 5 minutes of the market, 46, 5204. The S&P has moved 60 points. Do you know in the last 5 minutes, this is bigger than the last 400 trading days? Just these 5 minutes. The S&P has never moved this far in a single trading day in like, I don't know, a year or so. So the volatility is so overwhelmingly high and exponentially getting higher that just picking the wrong side, while to scale, this looks like, oh, this is just a normal trading day. It's normally trading. But go ahead and zoom in on this, okay? Since the market is opened, 51.62, 51.46, the market fell 20 points in a single minute, and then went up 20 points, and then fell 10, and then went up 20. And that's the normal trading day of entire day of the S&P most days. So imagine picking the wrong moment to enter a trade. Imagine every 10 points is a $500 loss per contract in the S&P futures. Right? And since I started saying that last sentence, we've already fallen another 20 points, and then up 20, and then down 20 again. Does this look like something that you feel like you can control? Just in general, this is why we teach this rule. Now, again, let me give you guys here, I'm going to pin it to the top, all of these indicators and these tools and things we have. Check it out, $35 for our Rocket Scooter platform, and then all the tools are here, and all the training on this is here. I give so many classes on this thing, it's not even funny. But do we all see the curvature? So you know that I'm not making it up. From exactly 2245, which is the break, we can literally predict it. Okay, you go from a nice little period. Oh no, wait, where are we at? Let's go back. You're here. You go from a nice little look how gently the market is selling. Okay, and 2245, which is exactly here. Again, give or take a couple minutes, but here it is. It starts to unwind, right? And let me just extend this. Look, I'm just literally drawing across the list. Do we all see this? And once, and every time I teach this, people go, "This is blowing my mind." Like I've never heard anything like this. But once you see it, you can't unsee it. You need to trust what I'm telling you is accurate. Okay. You see how clean and almost linear this is. It's falling like systematically, and then here's where it destabilizes and starts to get wider and wider, and then it starts to curve. Okay, that's what you see. So if you had Rocket Scooter in your pocket scooter, once you had that and you didn't touch the market, you weren't the person that bought any one of these dips to survive any of that nonsense. You saw this coming from, oh, I don't know, 2 hours ahead of the time. The risk interval is the most important number in futures trading. It is an exploit. Our team of engineers have reverse engineered a program that the CME group themselves made called SPAN. The program sets performance bond minimums, thus margin requirements for clearing firms, which are the margin requirement minimums that your broker must have for you to enter a trade, period. So as the margin requirements go up, it's telling you that the expected range of that thing is going up. And we have this ability to understand what that range actually is based on the risk of all positions in that instrument. CME Group doesn't publish parameters that go into the equation. We reverse engineered their entire system, and I have those numbers. And we give them to you, and they're called risk intervals. This is a piece of information that is not public, but mathematically derived by yours truly. We know the exact moment the market will destabilize, and we teach people our very first rule in our training program. We teach you how to see this, and all of our stuff is based on these kind of exploits. And our risk management section of our Discord, let me show it to you. And again, I'll come back and show you the curvature again. You don't believe me. Okay. The very, 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 very most important rule. There's 5 of them. We call them volatility runaways. Okay. Let me go here and we should get these up here. And in these videos, we talk about the same curvature. It's a phenomenal method. But imagine you sitting here and seeing this. And seeing this. And deciding to be a hero right here. That's the moment that it happened, 2245, right? Whereas everybody here understands. Today at 5 in the morning, I woke up. VIX was sooner likely in place. I need to check my computer. I just could feel that was in place, but obviously I need to check the number. Imagine right here that looks safe to you, right? Here's your traditional technical analysis. We are consolidating. You have lower highs, higher lows, and all of a sudden you're consolidating. But this is a screamingly high warning sign. There's a giant exclamation point here that says, oh my fucking God, stay away from the market. We all good here? So far, so good? All right. What volatility actually is, it is when you remove all the options part of the white paper equation. What volatility actually is, it is a balance of the price of the options of the underlying thing and the supply and demand of those options against all these other things. It says when the option is priced such that at a certain price that it has, that the return is equal to the risk-free rate, which is the way that Black-Scholes is based on, where if it's accurately priced, a trader on both sides of the option has an equal chance of winning that trade. Okay, and so options are priced based on some equation. VIX is based on some equation as well. And VIX is based on short-term outlook, 30-day window starting like 24 days in the future, plus 30 days, and there's a window of the SPX options, and VIX is priced on just that window. 1 month-ish of time. When you boil it all down, what volatility actually means is that when volatility is going up, the market has less resistance in the way of a standard move. Say that somebody dumped 100,000 shares in this example to the market. And volatility has no base number. There's no such thing as volatile. What's the starting point? Volatility is more like a change. So let's just pick an arbitrary starting point and call it X, okay? At X, 1,000 shares sell might move this far. If volatility X plus, I don't know, 5 more points, 100,000 shares might move it that far. And if we do X plus 10 and so on, you will see that the market moves even faster and faster. That's how much the market moves before it dips, it bounces. The higher the volatility, the easiest way to remember this is the first letter in the word volatility, is the bigger the V's. And you can actually measure that pretty simply, pretty easily. So an example is, let's just make a little box, right? VIX is slowly going up, but here's a V. It goes like from here to here and bounces. Here to here and bounces, right? And then here to here and bounces. And you can see if we were to pick those V's and put them like right next to each other, right? You can see that. And this is slightly bigger, and that is, oh, slightly bigger. Right? As we're approaching the level where all hell breaks loose, one can probably extrapolate the idea that it's relatively linear. As VIX is going up, the market's becoming wider. Yes, everyone, we all see that? So as the VIX is going up, markets become wider. But once you break through that key pivot, that key level, the V's are just destructively bigger. It just doesn't make any sense at all. So let's draw a couple of them. Like here's the first big dip where it bounces. There's there to there. No, there's there to there. A green candle there. Again, you guys remember my background. I'm an engineer. It's all about money. It's all about numbers. Then there's another dip right there, and it gets smaller. So what happens when the VVIX goes out of control is that the volatility of the VIX itself becomes very weird. Okay, and I'm gonna put them all side by side next to each other, and look how the VIX itself is like now out of control. Okay, there's another dip. And then all of a sudden, it goes like that. There's a dip there. And so on and so on and so on, right? This gets wider all the way down to there before it bounces. So if you were to zoom in on all of these, I know I'm just generally saying, I mean, when I zoom out, you can easily see it. Do we see that there's curvature here? This is what Rockseer is all about. We're the engineers of the market. We're going to teach you a little bit of math without boring you to death with some math. Can you all see that? Unmistakable how I just drew some boxes. And you can see it's not just the shape curves, but the bigger the market gets, the distance curves. That's the derivatives. Curvature is increasing. You're another layer in your derivatives, right? Concavity is second derivative. Speed is first derivative. You got it? So it's a fancier word for saying the market accelerates how wide it gets. It's accelerating, it's speeding up. It's not just getting wider, like the V's are getting bigger. The V's are getting bigger, exponentially bigger, right? They're curving, so you can't gauge a bottom. This whole long speech is to tell you, you can't pick a bottom because that shit is curving. And if you try to pick a bottom, you will fail and you will hurt. And in 5 minutes of time, you're up and down 30 points. You're hurting enough to blow up your account. So even though the market's kind of moved up right now, trying to scalp inside of this range, it can be violent enough that it can hurt you. Does everybody see the curvature here? And then notice another key factor is that it rapidly tightens and then rapidly curves again. This is the average distance of the S&P per V. At some points of the night, it was moving 60 points. Like it moved 60 points for it reverse. The milder parts of the night was about 25 points, right? And then this one was, oh, another 60 points. Or 70 points, something like that. 5, 6, okay, so 60 points here. 15 to 65, this is 50 points. So imagine that as the market's like trickling higher, and then it dropped 60 points before you bought. But the time before that, it only dropped 30 points. So the idea is that the market dropped 30 points and then dropped 60 points. You have no gauge inside of here where the best place to buy is. You just don't. The volatility is out of control. The market is struggling to find a bottom. So if you try to find a bottom, you're going to also struggle. Do you guys like that? Y'all like this lesson? Is this helpful? At least everybody here, throw me a yes in chat. Do you see the curvature? It's not the curvature of just the move. It's the exponential widening of the market. It's pretty neat to see that, right? This lesson kind of made us famous in the circles, in the future circles. There are professional futures traders still quoting the stuff that we came up with the risk interval from a decade ago. So the idea is that we proved that when the VIX moves that far, the market exponentially widens, and it's just math. It circles back around to the whole basis of where margin requirements come from. But the fact that we can prove curvature and tell you there's curvature and just warn you before a market shits on itself is the whole point of what you do here at our team. At this moment in time, right here, it's a warning to me. And I'm at dinner last night. I'm crushing it. I'm eating a steak. I get home. I'll look at this. And yeah, the market's like, gently wafting lower right here. And some of you may say, oh, lower highs, higher lows, it's consolidating. There's liquidity. Let me buy the dip. No, that's not liquidity. So stop looking at charts to try to find liquidity. When people are like drawing pictures on a chart to find liquidity, they have no idea what liquidity is. Liquidity is inversely proportional times some factor of the VIX. If the VIX itself is going higher, it means that the options in the S&P and the 30-day window are less liquid. That's literally what drives the calculation of the VIX. The price of the options are so scattered because the supply and demand is all wacky and it can't be accurately tracked, and therefore pricing is weird and wonky in the options. VIX will go way, way, way up. So using a chart to find liquidity, and you will learn this here, chart shapes and patterns, unless you're fucking 6 years old, shapes and patterns are going to do nothing for you except to get you an A on your crayon exam in kindergarten. Try to use shapes of a chart to discover liquidity, which I hear so many newbie traders do. Well, it's consolidating, that's liquid. You are a fucking idiot. No offense. VIX is showing the lack of liquidity. Correct. So VIX is showing the lack of liquidity in options, which is reflected by the lack of liquidity in the market itself. So when VIX flies out of control, it's literally telling you the liquid part of the market's going. And the example is like walking on thinner ice. You can walk on ice, and let me draw it on the chart. Another thing to think about. You're walking on ice that's becoming exponentially thinner. This is the thickness of ice. This is where your little booties are. Okay. And at some point, the ice just becomes so thin, it will crack on you. But the thinness of the ice is exponentially thinning out. It's not like it's a nice clean thing like that, or even flat across the surface. You are, every step you take, it's accelerating its thinness. So at this moment in time, you can tell yourself that the market's accelerating its thinness as well. Think of this as where your buyers are, and the force that you're applying on the ice, you're the seller. The buyers are genuinely more scattered. They're less clustered together. And what liquidity means is the maximum amount of transactions that take place in a period of time. So if you isolate time to be like a discrete interval of like tick, 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 tick on a clock, then each tick, if there are more transactions that take place, the market is more liquid than less liquid when there are fewer transactions, right? So as time is held constant, liquidity is the amount of transactions. If the amount of transactions are held constant, then liquidity is the amount of time between transactions. So an example is if a transaction happens every minute at a fixed price, and all of a sudden 10 transactions are happening per minute at that same price, then the market's also more liquid. So it's a partial differential equation, which means you hold one thing constant, you can measure the other. So time and frequency and amount are both parts of it. You fix the frequency, the larger the amount, more liquid. Fix the amount, the larger the frequency, more liquid. So when markets are illiquid, both of those things can be a factor. Traders are farther apart from each other, and the amount of time they step back in to trade is chaotic and infrequent, maybe further away than average. So the idea, and the best way to think about illiquid on a time sense is a house, right? Housing market's not necessarily liquid because it might take months to years to sell your house, whereas stock is very liquid relative. You can sell your stock in seconds, right? So an investment measuring liquidity always measure like how frequent the transactions happen, but also the amount of people making that transaction, right? You want to go sell your house and you got 20 buyers lined up at your price, that's very liquid. And they're ready to buy now, that's also very liquid. If you got 20 buyers wanting to buy your house at your price, but they don't want to buy it for 10 years, that's not that liquid compared to they want to buy it now. So when you think about liquidity, it's like that's a thinness of the floor, and where your house buyers are scattered in the house example. If you have a bunch of buyers lined up right here, ready to buy right now on options, see, options are priced at expirations. So the reason that time comes into play is how far out that option expires. There may be a buyer at this price at that time. There may be a buyer at this price at that time, right? Because options will expire in the future. So as the buyers become like scattered in both price and time, this is less liquid. Then if all the buyers are like wanting to buy expiring options here for our current price near where we're trading. For trading here, this is more liquid. Everybody wants to buy. They got calls right here near the money that expired this week, very liquid. This person has calls way out here. This person has calls way down here and way out here, less liquid. So like the more scattered your buyers are, and the way that you know where your buyers are a month in advance is options. Why the VIX equation is based on SPX options. Okay, Corey. All right. Got yourself some liquidity math there. When you try to talk about liquidity, it's very sophisticated calculus, guys, and I try to explain it in a way that like non-math majors can understand. Is that good? Did y'all follow? Did you follow along? So far, so good. Liquidity is really hard to understand, but the idea is that, you know, the market is tumultuous to a degree that you can't even measure. And then, you know, a couple of minutes ago, right at 9 o'clock, let's actually take a look at this. Guys, don't forget to sub to the stream if it's your first time here. We're gonna talk about some notable market crashes today. Again, the market being unstable, the V's being so wild, 51.97, 52.50. The market moved 60 points in 2 minutes. Just explain to me really quick, when I make a living on 10 and 15 points of the S&P, I have a 4-story house, drive a Maserati, I have a pretty decent life. I only need the S&P to move 10 points for me to have a decent life. 60-point moves in the S&P as a seasoned trader doesn't make me feel happy or like, oh, I can miss out on a huge trade. It makes me feel smart to know I can see this coming from, I don't know, what was it, 8 hours ago? To know that the market becomes very unstable to a degree that I don't want to touch it. It's guessing at this point, and the V's are so wild you can't even think about it. I need the market to move 10 points a day, and I've got my financial freedom. That's the way I feel. The market moves like this, I tell myself, thank God I'm not on the other side of that trade, because the stomaching of moves that large is something that even seasoned traders don't ever get used to. But we know it's coming if you're good enough to see it coming. Matt's flex is crazy. Oh, I don't even flex on half the things that I have, but I flex a little bit. Matt's thrown 2 million cash into building a trading platform. I mean, let's just be real. That's my biggest flex. I didn't take on any private equity groups or venture capital to build a trading platform. Daddy just pulled 2 mil out of his bank account and did it. That's a big flex. and give it to you guys. 35 bucks. It's the biggest flex. I built a tech company from my garage. Well, not really a garage, but from my house. It'd be kind of cool if I did it in my garage, like Palo Alto style, but. So just keep in mind, the understanding of what the market can be like. Watch. If there are streamers out there today, maybe streaming, maybe trading, anybody that's trading in here doesn't understand the market. They don't understand that you can see kind of moves like this a mile away. Now, I don't see this and say, oh, okay, this is going to be palatable trading, easy to trade. I see like market moving 60 points in 2 minutes, and I go, the average move of the S&P per day is roughly a risk interval. We talked about that earlier. And in the same chart, it is roughly 36 points per day. Like it takes all day to move that 36 points most days. Here, you're moving double that in a single 2 minutes of trading. The speed of this is scary to someone who looks at the market as a way to make an income. If I can see that's going to be unstable, I can avoid it from a mile away, which is why risk interval rule on VIX #1 tells you that all your other risk management rules are likely to trigger. See how most all those lights are red? There it is. So the fact that the VIX can destabilize, the red lights mean don't trade, by the way. And we can measure that destabilization point all the way back to here. I can almost predict that when the stock market opens, it's going to be ridiculous. And so one thing that you'll know that if you're using our techniques here is that from this point in time, you already know that you're outside of DD band #1. #2 is, you know, the VIX is about to destabilize, the market's going to fall out of control. And as I'm talking, in the last, I don't know, 2 or 3 minutes, Nasdaq has fallen a ridiculous amount as well. So one of the best parts about trading and trading for a living is control. Being in control is one of the best things you can do. And being in control is saying I can identify the worst part of the market before it even happens to me. That's really what you can control, is how much you bet. So one thing you can't control in the market, how much you bet. And I'm going to choose to bet 0. Because I know that I can't control the market very easily. And I know that the market's going to move so rapidly and overshoot all my pivots that it's not really worth touching. Now let's talk about our pivots really quick. I don't know if you guys remember me drawing, but the S&P, I drew this from earlier, and we'd probably be there, probably be like that. The Nasdaq's probably going to have pivots from there to there. The Russell's probably going to have pivots from there to there. And if we break, this is bad and likely bounce right there. That's likely to bounce there. The VIX is likely to bounce right there. But the distance is so wide. Look at this, 150 points of move here. Not from the faint of heart, okay? You guys understand that, right? Be safe in like modes like this. Just be very safe. All right, historic market crashes. If you like the lessons, we're here every single morning. Best traders on YouTube, this group, not just me, this group. We've been here since 2016 streaming. We're real traders here. We create a lot of cool methods and things. We'd love to share them with you guys. Feel free to sub to the channel. Come here every single day. We're here twice a day streaming, and I'm about to be on a podcast in about 1 hour with the great Stock Market News and Wolf Financial and others, and we'll be talking about this market crash. Okay. All right, you guys ready for it? This is notable crash zone. Everybody do me a favor. Go here. Here's a tweet from today. It's about why the markets are crashing. Why the markets are crashing today is a volatility event. The markets are just responding to a volatility event. That's today's crash, quote unquote. When the markets are curving lower, that's a crash. Or when the markets trade 3 days red, red, and red, I call that a crash as well. So internally, why the market's crashing today is the VIX. So far, so good, Vin. The VIX itself caused the collapse. The market, the behavior of the market created a domino effect, which crashed on itself. Now, we had a couple of factors that led to that kind of fear, right? Let me bring up some things for you guys. First and foremost, Bank of Japan raises interest rates. Okay, that was a trigger in overnight trading that started causing a little bit of kind of nastiness in the market. Well, that is around this time period, depending on daylight savings time or not. Oh, I'm sorry, you can see my chart here. Depending on daylight savings time or not, Japan's gonna open roughly at 8-ish at night, or maybe it's at 8:30. No, it's 8. I think it's at 8. Give or take 7 my time. You're here. Let me get you guys exactly what time that was. Yeah, so 7 o'clock my time. I mean, that's just like right here. This is 6 Eastern. So right about 8 Eastern, right here. That created that. Right, markets started to fall pretty rapidly. We were already gapping down, trading down. We also have issues in the Middle East. There's rumors of, preemptive strikes, things like this. You have Iran, Israel, button heads. US is sending troops to that area of the world. That's creating a little bit of panic. We know that the market can panic on threats of war and things, as September 11th is one of the times when we triggered circuit breakers in the markets, right? So somebody wants to force the Fed to lower rates. There could be a little bit of that at play, or just panic profit taking. I like to think that there's not normally a conspiracy in the global markets. They're not like conspiring to, hey guys, let's all crash the market so that Fed can lower rates. You could have a couple of banks behind something like that because they're the ones controlling the bid, because they're market making. But in reality, you have a lot of earnings that kind of came out missing the boat. And obviously the market has been so strongly bullish without a normal correction that it's just correcting in a normal sense by crashing. Like normally we learned during COVID is that a really strong bull market. So let me preempt this by saying the market is not at all a bear market. Today it is, but overall it's not. During COVID, we learned that the market just unwound and like created a panic, created a selling that triggered everybody's confident tight stops and threw puts in the money and forced people to panic sell, and it dominoed some selling. And typically when markets crash out, it's just domino effect. Selling begets selling begets selling. People bump into each other and then knock it lower, which bumps into more people, knocks it lower. It's a mechanical thing rather than a fundamental thing. The fundamentals of the stock market actually reside in like the macroeconomics are actually pretty healthy. The economy's in great shape. It's not the best it could be, but it's not in bad enough shape for the stock market to crash into a bear market. This is just unwinding of liquidity of a really strong bull market, coupled with a volatility event to make it worse. Okay, this is just normal selling. You normally see normal selling. Sometimes it's weeks of trading down. Sometimes it unwinds in a month or so. You normally see in bull markets periods of the market relaxing. You had a month of selling back in 2019, a month of selling in 2019, a month of selling in 2018. It's traditionally expected for markets to just correct on the way up. Markets go higher, 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 higher. You spook somebody to sell just enough of something. And what happened in this particular market is that we rallied so high on the tech boom, okay, with very little stopping, that once people decided to start selling some of their positions in tech leading up into earnings, this is what's causing this. Don't listen to anyone else. This is what's causing this. Leading up into earnings, people started taking profits into big tech earnings. And the fact that we knew it wasn't panicky is because of what? What were they? Let's see if anybody here knows this. People were taking profits in tech leading up into earnings because it just overpriced in earnings. Number one, we overpriced in earnings. And number two is the market is pricing in rate cuts. Okay. So clearly rate hike fears, even though it's Japan, and Japan's had a troubled market and economy since the 90s. It's never really recovered as fully as it is. So Japan's a bad benchmark for the rest of the world, number one. But number two is that even the thought of a rate hike is enough to scare our market, right? I'm more in tune to the idea that the Fed would be mobilizing right now to talk about an emergency rate cut if this were to persist. Not like today, but if the S&P or the NASDAQ were to fall, I don't know, another 10%, you can bet your britches the Fed will meet up and cut rates to stop the bleed. Okay, not going to do that yet. On 3 days of selling, the Fed understands that this is within the random realm of, or the normal realm of selling. Okay, does anybody know when people were taking profits in tech stocks before earnings, what they were doing with them? Were treasuries going up? Were people going in there and buying treasury notes? Let's look at the TLT, ETF, ETN, ETF, whatever one too. Not yet. Not yet. Before people are buying them now, but before it's sold off. So that's not the answer. People weren't rotating out of tech stocks because they were scared of the stock market. 1, 2, 3 days of selling. 4, 5. Here's 5, 4, 3, 2, 1. So in this mode right here, people were taking profit in tech, but not buying bonds, which is what you do if you're scared of the market. What were they doing? Anybody here remember? So, not buying bonds. Typically, if it's a recession or a bear market looming, or I'm just taking profit, like I'm the first out, I made my profit, now let me park my money into something stable. Let's buy treasury bonds. We weren't in the first 3 days of selling, sorry. We're seeing a lot of that. Does anybody remember what people were doing 5 days ago? Y'all's memory is that short? They weren't throwing their money into fixed income. Y'all, nobody here knows? They were rotating it into small caps, which means an even heavier appetite for risk. Because 5 days ago, come on, you're ruining the punchline. Zoom in on the damn chart. Because 5 days ago, the Russell peaked at a 3-year high. People's appetite was so bullish here. They were even risk on the small cap. People were, let's just take some profit in tech. And on this day right here is this day right here. We'll call this 1, 2, and 3. And day 3 was day 3. Nobody saw this coming. As a matter of fact, when you risk on into riskier stuff, your appetite for risk is just got bigger, right? People were like, okay, you know, shit, I've made NASDAQ is 15 up to 21,000. Wow, right? 15 to 20,000. That's massive, right? Huge gain. So Google earnings, Apple earnings, Nvidia earnings, let's just take a little bit of profit. And because the stock market's so healthy, let's start on the Russell. Let's buy small cap stocks. That's the opportunity. So when people are like, and let me explain to you, this is a thing. Let me explain to you how people think about markets. You guys ever heard of NFTs? Do they sound absolutely dumb to you? Does the idea sound like something that makes no sense? Do they sound ridiculous, right? Like, who would buy something like that? Who would buy an online picture that you actually don't even own? You just own a link that goes to it so that you can tell people I have the authentic certificate to own this picture. And somebody says, yeah, me too. I downloaded it myself. I've got it on my phone. He's like, yeah, but I actually own that. Yeah, but I have it too. Yeah, but I own it. Okay. How much did it cost you to own it? $250,000. Well, God, you're an idiot. Well, I mean, maybe not. Art dealers think of art the same way. You own the art piece. It's yours. You can brag to your elitist friends that you own it. And they can, you know, go over there and circle jerk each other about who owns what and who gives a fuck. You're not really making money off of it. It sounds like a stupid idea, right? Well, it wasn't a stupid idea when it's making money. Anything that makes money is a smart idea. Any investment that goes up is a smart idea, even if the concept's a stupid idea. If people want to buy it, then you get it on it. Somebody just said in chat, NFTs are for selling. That's right. If you're on the supply side of that shit, you're great. You want to be on the sell side where you can make money while if people want to buy it and it's dumb. People bought pet rocks in the 70s. And I mean, it was a thing. People bought pogs in the 90s. It was a thing. People bought things that didn't make sense those times, and people made fortunes off of selling it. So the idea is that if you're on the buy side of that and you're in the hype side of it, you only go into like dumber things as the safer things prove themselves to be stable. And the idea is that there was a time when stock market, let's just say like blue chips, went up and then kind of held the fort. And then like they always tell you, if you're pretending you're like a billionaire, right? And you have tons of money managers managing your assets. You can't just go out there and put $1 billion into one thing, right? You will take your money and diversify it as much as possible because that's the safest thing to do with a lot of money. So once blue chip stocks have gone up, your money manager says, look, your account is up. You made a lot of money. Let's go ahead and put your stuff into like riskier small cap stocks. Okay. And once those have stabilized, all right, let's go ahead and just put a little bit of fixed income in it just to give yourself something else. I'm just diversify a little bit. And man, everything's gone up. We need to buy some other things. Well, how about let's go make you Mr. Celebrity. Let's go make you a cologne. Put your name on it. Let's go ahead and buy you a club. Is that like Bruno Mars has a club? I mean, people buy stuff to move their money around. Hell, let's go buy a gin company. Ryan Reynolds. Let's go ahead and just move our money to all kind of places, right? So you buy more and more and more stuff, and then once that's all making money, then you buy the invisible internet money, and it's crypto. And once the stronger ones of those go up, Bitcoin, Ethereum, they actually have utility and purpose, then you buy the stupider invisible money known as shit coins, which there's a famous one right now on Twitter that's completely collapsing and people got bamboozled. Again, for the 20th time in the last 4 years, shit coins all go to zero. And then once shit coins are popular, then people buy the internet JPEGs as the last thing because everything's making money. You buy dumber and dumber and dumber and dumber stuff. Once everything else ahead of it did pretty good. Meme coins. So why would you buy the JPEG is because it's that mentality. It's called the hot hand fallacy. You made 5 free throws in a row that all sunk in the basket. It's a win. That's a win. That's a win. I can't lose, baby. I can't lose. Let's go all in on black. Let's go. You're on a streak. You think you can't lose. You diversify into riskier stuff. Whatever. I can't lose. Double down. I'm all in. Then you buy the silly JPEGs. Now, if you think NFTs are silly, they've still made money, but people wind into dumb stuff because the stuff here is like foundationally safe. It is in such a good position, you don't even question it. And once you max out there, you go somewhere else. Think about like what you do, like your 401k, right? You max out on your 401k, then you max out on your IRA, then you max out on your health savings plan at work, and then you max out and you're always like that's safe, something else, and then whatever's left, you put in a trading account, which is the riskier stuff. So as the safer things are maxed out, then you go into the riskier things. And the greatest thing about that is that it doesn't take a genius to understand that while you wind up the market from safe to unsafe, that you unwind the market in the opposite direction. The unsafe spirals out of control, and then the safe finally spirals with it. So people usually they usually buy the crappy stuff last. So when like you're at the peak of popularity, like, oh man, NFTs can't lose money, the peak of bullish stupidity is usually like, okay, it's time for it to come down. So as people are risking on into safer things, which is what we were seeing, safer blue chips, we had tech, and then we moved from tech into Russell. People were actually moving along the safe path. They were actually selling NASDAQ stocks to jump into Russell stocks. As the NASDAQ's selling, Russell's going up. That's rotating in a mode where the market's perceived as safe. So in reality, the only thing worth discussing that's abnormal is just the last 2 days. Here. So the idea that we saw a natural progression of things as people were just moving, getting out of the way of tech and taking their money and putting into riskier stuff is like NFTs. You're gonna buy dumber things because the better things can't win. The problem is that the Russell itself started selling, right? So actually, I'm sorry, the first 2 days. So it's actually the last 3 days we need to discuss when everything's falling, okay? The Russell took a nosedive on the 1st of August, along with everything else. The perception is that the market's no longer safe. And then of course, in the last 1, 2, 3 days, people are rushing and throwing their money into treasuries, which I always like to look at the TLT, have exponentially risen up to 100 from about 95 before. Are there any crypto tokens in the top 10 that you think are shit? I think after the crypto frenzy dies out at the end of this in 50 years, 1 or 2 of them will still be around and be very high utility. Just diversify enough to where you're in the winner when it happens, because your winner might win 1,000 times over, whereas 99 out of 100 of them are going to lose, right? It's the penny stock methodology to where if you just spend $5 on 1,000 different stocks and one of them goes up 500% or 5,000% and you got options, you've magnified your gains thousands of percent. The one winner will offset all of the losers time a factor of like 10 or 100. So when it comes to things like crypto that have no physical utility really in this world and no one really uses it but enthusiasts, but the world may see a future there, your job is not to pick the right one. Your job is to invest in all of them and let the winner win you over. For every Microsoft that made it to be a $1 trillion company, there were hundreds of people at that time, that same area of California, creating software, creating tools, creating things for the computer era that didn't make it. So you got to pick the next Microsoft, right? There were hundreds of online retailers, and who would have known that the one that sold books, so ironically, in the age of the internet, where book sales are in absolute decline because of the internet, that a book retailer named Amazon would become the largest e-retailer in the world. Isn't that crazy? Ironically, would have been everyone's last pick for the fucking dodgeball team. I'll tell you that. Of internet companies. No one would have ever have thought in 2000 that Amazon would become the juggernaut that it is. So which one of your sleeper hit crypto coins is the big winner coming down the road? Is it the Amazon? People were like watching Barnes and Nobles close one at a time in the early 2000s. Once the internet got big, people were doing e-readers at that point. People were getting all their stuff online. Newspaper companies were tanking. Internet was taking over. Borders, you guys remember that company? I heard that's probably, I don't think that's around anymore. Who would have thought at the time Amazon would have been the winner? So right now it may seem like Bitcoin or Ethereum is the winner, but you You never know, because once the utility takes over, somebody's going to latch on and be the one that's going to win. So the question is, which one is going to be the winner? And you won't be able to tell, because whatever makes them the winner hasn't been invented yet. They haven't created the thing that gives them the utility that'll make them be the winner. They haven't shifted from selling books to selling everything. You guys got it? So the question is, which ones are shit? They're all shit. Every single one of them. Every single crypto thing right now is absolute dog shit. But one of them is going to turn to gold, because I think there's a future with it. But I don't think it's going to happen until my kids are my age. Kid is my age. My future kids are my age. And I don't think it's going to happen the way we think it's going to happen. But I think all crypto is complete shit right now, especially meme coins. I think they're all worthless. They're all proving to be worthless right now, because they're unwinding the worst. Like that right now, I've been watching crypto meme coins just delete themselves overnight, like to zero or close to zero. I've been watching bag holders unite on social media, thinking, let me buy some more here. And they don't understand about what I keep drawing is like the spiral of death. Things are unwinding in the opposite direction. Stock market needs to bounce first before that stuff starts to bounce. People aren't going to go in there and start boosting these things. So just be careful understanding that once crypto tanks and then small caps tank, bonds go up, stock market, this is genuine fear of worsening conditions. Now, I personally think this is going to stabilize within weeks to months and keep rallying. I think that the prospect of a Republican candidate winning the election going up is bullish for the stock market. The Democratic win would possibly be neutral for the perception of traders. This isn't like a political call or like saying which side of the fence I'm on. This is just saying from traders' perspective. Historically, Republican victories have been seen as more favorable to large corporations and therefore more bullish. As Democratic policies tend to spread money around to people that only buy consumer goods with it. Republican policies spread money around to larger companies who invest that in themselves and other companies, which build jobs and wealth and things that people don't see the trickle down effect from that. So while I always say like the Democratic side can increase consumer spending as you bring people closer to the middle as far as income goes, when you enrich the top, they build things that trickle down, that creates jobs, which brings more people into the middle as well. But it creates more of a longer term bullish effect in the market. And so traders usually vote bullish for Republican. Trade bullish for Republican. They do. And so part of this bull market, a lot of it is also riding on the fact that I believe that people believe Trump may win, especially with Biden stepping out of the race. It's kind of like a bet that you would make to say that one side has just appeared weaker compared to the other, and Wall Street makes the bet on that. Who do I think is going to win the election? I firmly believe the possibility. I don't even know who the Democratic they have a candidate for. Yep, nobody knows. But November's coming up very, very soon, and just as a betting man, not telling you guys who I'm voting for, who I want to vote for, who I want to win, but as a betting man, I would bet that Trump would win. The market is certainly betting that way. So we'll see. So any politics will also lead into that kind of behavior in the market as well. But I don't think that's at play right now. I think most of what we've seen the last couple of days has the panic. A lot of that has to do with the potential for an American campaign in the Middle East. The fear of that just sparked as markets were healthily rotating from large cap to small cap at the same time. We've got Israel announcing preemptive strikes and US moving troops over there. It's like that came at a time when people were just like moving things from one stock to the other. And while they're walking across like a bridge with all their stuff, somebody came through and kicked the bridge over. And then it just created a volatility event, which unwound the market very quickly, which made people rush into buying treasuries and parking their money somewhere safe. And then Bank of Japan raising rates scared Wall Street overnight. So it's like, imagine that if you're moving your money from like large cap to small cap, that there's a period when the market's just vulnerable, right? You're selling into a bunch of buyers to move your money over. But if a few things happen to scare those buyers from being there, you're selling to move money over. Then all of a sudden you're selling to a dropping bid. And then everything starts to fall. And then you go in, you're moving your money to small caps, and then that's crashing under your feet. Then you pull your money out, which makes it crash harder, which then unwinds the market and then crashes the big caps. And that's actually what happened. Did I catch all of that? Imagine the Oregon Trail. Where people are moving from, I'm gonna charge all 3D here, okay? Yeah, nice little, remember the Oregon Trail, that video game we all played? This is me drawing like a cliff. Okay. And imagine there's another cliff over here. People of prosperity, they built skyscrapers apparently in the 1600s or whatever. And all of a sudden, they build a bridge from here to here. Okay. They load up their stagecoaches and they go, all right, guys, we're moving. Hey, Mabel, hitch up the horses. We're going across the ravine. All right. I don't know, Paul. It looks unsafe over there. New opportunities. We're going to build our fortune over there. Where everything was nice and safe over here. We're hitching up. Let's go. Going this way, right? And while you're moving things over here to riskier territory, this bridge is like wobbling and shaking, right? And then other people are like coming onto it. Let's move our stuff to unsafer waters, more trains coming through, right? And then enough people get on this thing that it breaks the bridge. And then all of a sudden they all fall into it one at a time. And then people over here are like, huh. And this person's like scratching their head. They're like, I don't understand. He's got a top hat on. I don't get it. Hey Betsy, I'm starting unpacking the stuff. We ain't going across. We're not going to go across the ravine today. This crash and that person crashed behind it and that person crashed behind it. It's people who are moving money. What it does is it halts everybody that's wanting to take that risk to say, let me let this happen. And let's just kind of step aside. It's a domino effect. You get too much money moving too quickly that it creates an effect where as it's falling, now again, as money was rotating into the Russell and it turned around and started selling, imagine the opportunity here that you see here. I'll put it one more time. First and foremost, oops, the S&P. Now this is what happened. And volatility just created this. So I mean, I like in the next day or two, the market's gonna have some pretty good green days. I'm probably having a good trading day tomorrow. So it's still, volatility typically collapses very rapidly. The S&P had already been selling a little bit leading up to this. So the S&P was already, people were rotating out of the S&P almost a month ago. And let's go right here. And the Nasdaq the same. The IWM was rallying up until 3 days ago. So people were like crossing the ravine, more and more and more stagecoaches on that bridge, moving their money to here. So much so that bridge got overloaded. And then as soon as it started selling, imagine that you were selling all of your stuff right here, or selling some of your stuff to take profit. Delete these like lines here. Filling in some gaps on the Nasdaq. Let me just delete all that. Yo, what up, Traders Tavern? What's up, dude? All right. So imagine that you're like all the way up into here, and you're selling your NASDAQ and selling your S&P just off of earnings, and then moving into Russell here, here, and here. And as people are starting to move into Russell, they're, okay, let me buy it, and it's dipping. Let me buy it. Oh God, now it's hitting my stop. Okay, let me immediately sell it, and let me go into bonds. So that's exactly what happened. People were going from here into Russell, here into Russell, here into Russell, and even here into Russell. And then as the Russell fell, they got in and they turned around and got out. So a little bit of people in here moved their money into the Russell, and the Russell fell and they got out, and they moved their money into bonds, which in the last 3 days have rallied on the effect of this. So imagine people are crossing the ravine, and as they're moving across the bridge, and the bridge fell, and well, then they got out, which caused other people to fall. So once Russell started to unwind and people rushed into bonds, it scared more people, which forced them to run into bonds and then unwound things a little more. And that spiral just took place the other way. So the idea that people are immediately buying, like throwing money into Russell and then immediately pulling it out, completely collapsed the Russell. And that started the selling in general, and then everything else fell to go with it. Like people were selling across the board everywhere. So, you know, you had some like last minute folks selling their S&P, selling their NASDAQ stocks and buying Russell in the high. And then the buyers stopped coming, and then people that jumped in immediately started selling, and then all of a sudden it just fell and everything fell with it. And then of course the Middle East stuff, Bank of Japan just came at the wrong time and created more selling, created more panic, brought everything down. So is this a permanent thing? Absolutely not. This is not a change in the dynamics of the market. I mean, the economy. This is just change in the dynamics of the market. Tomorrow could very well be the day that it bottoms out and then rallies all the way back up. But today, we don't trade it in these kind of environment at all. We leave it alone. Let it figure itself out and come back tomorrow and see if we get bull pivots tomorrow. I'm going to wake up every day, look for pivots. I'm going to find bullish liquidity maps. This one shows bearishness. This one shows bearishness. This one shows bearishness. Everything shows pretty nasty stuff. The VIX itself shows bullishness. So I'm going to wait every day and then come to a nice bull market where I can find a nice decent pivot to long off if I can find it. When we'll be able to code indicators on the Rocket Scooter Marketplace. That is something that's a T-minus a month-ish out. We have a lot of things that we're building to support that, to be able to release that to the public. So as soon as we do, you'll be the first person to know. I wonder if NQ will halt today. I don't think NQ, I don't think any of the market, it's possible. I don't think it will, but it certainly is possible. If VIX stays here, left side of the screen where I'm circling, this is very bad. Very bad. Okay. If the VIX is down here, then it will stabilize a little bit. Stable. So if the VIX starts to run away and get worse, the market can just crap on itself. I love market crash days because I can see them coming from a mile away. Do you notice how much money I've made or lost in the stock market? What do we like to call it? Take a guess. Since Friday, how much, or actually since like Wednesday, Thursday of last week, you guys remember me trading, saying that I'm only trading, actually since Monday. I'm not trading real money. I said I'm just going to trade in the Apex eval accounts because I'm not going to risk any real money. Do you remember that since last Monday? Who here, raise your hand, who here remembers me seeing this coming from a week ago, saying volatility's out of whack, market's looking weird. We had a couple hints, right? The DD ratio on the S&P dropped below 50 a couple of days. And I just said, it's too rich for my blood. I'm not going to trade anything but eval. Guess how much real money I've lost trading in the last week? Guess. This is why you join Rocket Scooter. Take a guess. How much money have I actually lost this week? Take a guess. Since last Monday. How much? How much? How much have I gained? Well, also zero. The point of it is when I can see this and smell this, I'm gonna let the idiots out there blow up accounts and be sad and be crazy. I'm just gonna comment on it from the sidelines, have a good time. I had a great time. I stayed at a resort on Friday, a golf resort, sat by the pool on Friday, got fucking drunk and passed out. I went to dinner last night with a girlfriend. It's a really fancy place called Toca Madera. Fantastic. I had a guy come out doing a guitar solo by the table. Tweeted about it. All the while, the world's crumbling under my feet, but I've got no money invested in it. You can see it coming from a mile away. No money, nothing. I didn't make anything, didn't lose anything. At least 300 bucks. Yeah, probably. Literally zero. It's like, let the market do this. And I've learned over my years of trading is when the market feels or looks or does weird, they'll just let it happen. Just get back, let it happen. You're getting mugged. Somebody's like, give me your wallet with a knife. You're like, just let it happen. Don't fight back. Just here's my wallet. Give them what they want. Let it take. It's going to come and then it's going to leave you alone. And that person will never mug you again. The market's being mean right now. The abuse will stop at some point. Just sit back. My heart rate isn't going up. My portfolio isn't going down. It's also not going up. The market just got cheaper and I got all kinds of money ready to gobble up that dip at the right time. Been waiting for it, baby. Been waiting for that dip. Still waiting for it. Just like in October of 2022, if you guys go back to my old streams, when I was popping six-figure trades, buying JP Morgan calls, buying Nvidia calls, buying Apple calls, buying QQQ calls at the base of October of 2022. You guys remember some of those trades I made back then? Hell, one of my videos is actually called my 1200 and whatever % gain in JP Morgan. I think I had $60,000 invested in that. Do the math. Go back to my YouTube. Somewhere 1200% gain or whatever it was. Because I waited. I'm still gonna wait. I'm gonna wait until things get better. I'm gonna wake up today and say, this is it. I hate my boss. I hate my work. I hate everything. This is the day I'm gonna make my financial freedom. This is the day that the guy who's done it is telling you to sit the fuck out. Wait. Wait and wait and wait. This is not the day where heroes are made. This is the day where gamblers are split in half and half of them are rewarded and the other half aren't. And the ones that made something blew it up by the end of the day too. Promise. Is the half gap on liquidity map significant and why? The half gap, PJ, is the most important, is the most important pivot intraday trading. The open and close price are the two most important pivots. Let me make it big so you can see it. They're the biggest, highest volume pivots of the day on any equities chart. The open and close. You mark them here on your chart. The open is where we open at 9:30. The close is where we close at 4. The open and close are two of your highest volume pivots. As you see, there's a pivot there, pivot there. We try to use the resilience indicator to forecast what happens at the pivot at the half gap. Resilience is a tiebreaker because it's an aggregate of what the stocks are doing in their own redistribution zone, which is what we call it. So the distance from here to here is the zone. If resilience is less than 0, the flow is that way on the index. As we see, the white line is way below 0. Very easy to see that using Rocket Scooter's resilience number, which is only available at the link that's pinned at the top, 35 bucks. Get these indicators to your charts. The flow from half gap is negative. The halfway point is like this gamma balance, this delta balance as well, right here, where people are like kind of hedged on both sides. And that halfway point is usually resistance when resilience is less than 0, more often than not. If this was somehow above 0 and we're trading down here, then I bet that we trade up here at that point. So right now, there's no evidence that this will end up here at any point today. My confidence is low. Okay. This is certainly below 0. More likely here. Makes sense, PJ? Your US Sony seeing 2 solid rejections this morning. It's pretty common to make, so whenever I'm scalping, I'm always trading off of the pivots, the redistribution zone, especially when I'm doing futures, any kind of futures, oil, you name it. Pivots here, here, and here are 3 of your strongest pivots, period. Pick anything, right? USO, let's talk about oil futures. USO is the largest commodity pool in the world, by the way. The US Oil Fund is a very big fund. It owns a lot of oil futures. And yeah, you can see there's always pivoting action off of there. Now, to bet which way you go, you need some other confluence indicators, but you can see that there's pivoting from the open, pivoting from the open. You can't argue that you're seeing pivots there and there. There's your volume on that. There's your volume on that. There's your volume on that. So these are volume spikes. It's predictable. Picking the direction is hard, but showing where the volume is isn't. And one can easily see that there is high volume. There is higher volume relative to the average where you're trading. Here, again, it spikes a little bit relative, right? And then here it also spikes again. They're very important pivots because what happens is at the start of the day and the end of the day, where your volume is the highest, if you guys enjoy the content, please subscribe to the channel. We're here every single day. I do live trading every single day. I've currently I placed top 5 in the Robins at the highest peak of it. I'm gonna jump back in and try to win that thing by the end of the year, which is the International Futures Trading Competition. I peaked in the top 5 on the leaderboard. I live trade, been live trading since 2016 on air. I'm the creator of this trading platform. And these folks in our community are some of the best traders I've ever known in my life. You guys, y'all join our community. I'll tell you, go to the link above. It's pinned at the top of the chat. Check it out. Discord, very, very, very inexpensive. We also have a free part of the Discord. The chat room is free, so you can hang out all day long for free. Hang out with a bunch of our peeps and learn how to trade. Yeah. So here, you just got to take a look at the start and end of the day. Here and here, here and here is always the highest volume. So the midpoint of the next day between where opening volume opens at and closing volume closes at, this is where all the bulk of the orders submitted to market makers by institutions are filled. The start of the day and the end of the day. It's filled at one single price. You can Google MOO and MOC. Google. And you'll see that the open and close price are very important because the amount of volume that goes into them at the open and close. Therefore, the halfway point is kind of like the balance point for the market maker. If the market volume looks like this day to day, it's like a giant J. So if this was the trading day and we traded like up and closed here, and then we gapped down and opened here, and then we traded here, high volume, high volume, high volume, and then high volume. So this is volume, this is price. Say that everybody here was selling more than they're buying. So there was a sell imbalance of 1 million shares. And then we gapped down, and then right here, there was a buy imbalance of 1 million shares. Okay, well, the sellers and buyers are neutral, and the market goes to the middle, which is the liquid spot between sellers and buyers, to test. And so if people are selling and buying inside of here, then it would make sense that the pressure would drift it towards the middle. And when you get there is the peak amount of hedging, which means the peak amount of order flow or delta hedging, which means high volume. So when you touch the middle of two highly hedged spots, you're always going to see volume. That's a key takeaway, which is why the half gap is always very important. Because all it is the balance point between yesterday's close and today's open. As in the example of the indices, everyone was selling at yesterday's close. At the open, it looks like lots of people were buying. So it makes sense for the market makers to go to the middle and say, all right, what next, guys? What are you gonna do from here? And we're sitting in the middle. The middle is a great pivot. If I was long, in a day like this, I'd always exit at the middle. You know, again, unlike you guys, I might be a little more patient. Maybe I might be less patient than me. I don't know. I'm very patient. I see big market sell-offs like this as an opportunity to replenish, well, not replenish the word I'm looking for, to engorge in a massive, major bullish trade for the longer haul. This is an opportunity for me to put millions of dollars in my pocket. All right, when I find the bottom, the right, I don't see today as a day where like, all right, this is the day I'm gonna load up. When I see VIX break risk interval like that, I let the market completely die out. And once VIX is trading inside of a day where the risk interval is stable, we're inside of that 2.8 range for the equities for the future session. That's when I usually load up. Just wait. I'll show you guys. Maybe I'll do a little thing. Maybe I'll do like, just for fun, for funsies, maybe I'll do it with options. Give like 20 grand or something and I had a diverse basket of 10 different company options. Tech first. Let's see if I can't catch a good bottom. Let's look at monthly maps really quick. Today's not the day to do it. IV is too high. Volatility is way too high. The options would be priced way too high to buy. It's a stupid idea. And monthly map doesn't give me any clairvoyance as the market's stabilizing, right? Looks like it's falling out. Monthly map projects into the future where we're trading. The S&P has fallen so far into bear territory so quickly. I need a couple of days for this to stabilize. So in the near foreseeable future, I'm not telling myself there's a dip anytime soon. This is in bear zone, bear zone, bear zone, all the way through. This was enough to kill the projection, which was bullish for 3 months. So what I do is I'm going to wait every single day to see if this changes and moves its projection lower to where we're actually trading back in equilibrium again. So I'm telling myself right now, I don't see a bottom anywhere soon. This will always be a day behind, but there will be one day where we bounce up and then we're trading and we're in between bull and bear zone. And that's where I'm a little more comfortable and confident. Once this gets to be above 5 again, 0.5, I'm back to being long. And I'm not just back to being long for a day trade. Once this is above 5 and this is trading outside of bear zone, I'm bullish for the long haul. Okay. But keep your ears peeled, because the moment that the Fed decides to cut rates in what might be an emergency rate cut, which is not going to be today, the Fed's probably meeting to say, you know, let's watch it. Let's save it if it falls below X. Right? 500, 400. They have a number they're looking at. The data's still good for them to trust the economy is going to heal itself. But they can't let the stock market crash, because that's going to start to create unemployment raises. Right? People are gonna get fired, and that's gonna just slow everyone down again. It's gonna slow the progression. So the Fed has to give some confidence to the stock market by announcing rate cuts if it falls too far, but it hasn't fallen far enough yet. They're gonna do that yet. Oh shit. I gotta be on Spaces. All right, Twitter Spaces, guys. I love y'all. I'm back at 2. Everyone go to the Discord. Hold on. Actually, I'll stay live on Twitter though. Go to Twitter. Everyone go to the Discord. If you like what we've done or like what we're doing, you like the education here, you'll learn everything you need to know about the markets here at Rock Scooter. We are the teachers of the market, the best teachers of the market. You will learn the modern market here. No lie. See y'all later. All right, jump in the Discord. We'll see you guys. I gotta get on this podcast really quick. Love y'all. All right, we'll see y'all later. Don't forget, guys, sub to the channel. Give us some love.